According to global credit rating firm Moody's, Sub Sahara Africa will remain the second fastest growing region in the world. Now, this growth will be driven by infrastructure spending, institutional reforms, and a growing middle class. Here is more on that. Sub-Saharan African economies have experienced robust growth in the past decade, and according to credit rating firm Moody's, this growth is not about to stop.
Growth is a key issue from our ratings prism, and in our view, Sub-Saharan Africa will remain the second fastest growing region on the globe. And what's driving that? Well, it's the still robust commodity demands from emerging markets. It's the strong infrastructure spending, trying to reduce infrastructure bottlenecks. It's the ongoing regulatory and structural reforms that are improving the business environment and more conducive to growth. And also the emergence of a middle class in the Africa space that means that there will be self-sustaining demand over the longer term.
And looking into the East Africa region, outlook remains positive despite political risk in some countries.
For the most part, with the exception of Burundi, most countries have strong growth prospects. Okay, they're projected to exceed the median for Sub-Saharan Africa, and this is really important and interesting for the region, because our growth in the East Africa region doesn't necessarily come from big commodities. We're sort of the exception to the commodity story. When people think about the Africa success story, I think there's a lot of focus on commodities, but that's just not the case in this region. I mean, there's tea and coffee, and those have sort of traditionally played somewhat of a role. But I think the strong growth rates that we're seeing in the region are more indicative of kind of domestic development and diversification of the economy away from cash crops, which were sort of traditionally the big exports of the region.
Apart from gauging economical and institutional strength, what are the other parameters used to determine sovereign credit quality?
Fiscal strength makes sense. How much can a government generate in revenue? What's its capacity to repay some of the debt that's outstanding? How much are the fiscal pressures equating into potentially future credit risk? Or on the upside, how much is growth and future growth potential going to boost revenues and enable governments to be able to not just take the spending that they're doing now, but also generate revenues, particularly foreign exchange revenues, in order to pay down the debt in future. And then finally, the susceptibility to event risk. What's the current account deficit look like? If you're running a current account deficit, what's the political situation look like? How's the banking system in terms of the evolution? What risks does that pose to the sovereign balance sheet in the event of some need of recapitalization?
Turning to East Africa, innovation, which has led to the creation of a robust financial system, has also played an integral part.
The consumption side of the equation has been extremely important. The development of a consumer class that has a very stable, well, somewhat more of a stable income and can contribute to consumption in a stable way. From a supply side, I think one of the factors that has been extremely key is innovation and improvements in technology. Kenya is a leader in terms of the technological advances in the financial services industry.
Despite the positive news, there are still some challenges.
Sub-Saharan Africa is suffering from the commodities-related downturn. I think it's the second sharpest deceleration behind the CIS, Russia and the Commonwealth of Independent States in Eastern Europe and Eurasia area, but we're certainly not expecting a contraction.
And even as commodities continue to experience a downturn, the Nairobi Securities Exchange plans to establish a commodities market in order to diversify its product portfolio.
We are in advanced stages of launching a derivatives market. About 2 weeks ago, we had a discussion with the market in terms of the templates or on contracts we would like to have traded in our market. We're looking to do equities, single stock futures, index futures, both futures and options. We'll also look at doing interest rate products and currencies. So, but most likely we'll start with equities, currencies, interest rate products, and medium term move on to commodities. And we anticipate launching the derivatives market in sometime in Q3 of this year.